as an exchange team, what we've looked at is, there's 3 or 4 key areas to build a market, a capital market. And I think a money market is really your starting point. It's not really something that gets the most media attention. Usually you hear about stocks, the stock indices or derivatives, etc. But the building block of the financial markets, how you price a lot of assets, etc., start with the interbank markets. So if you've heard of LIBOR or Euro IBOR, some of these overnight lending rates, they're usually used to price a lot of assets in the financial markets, a lot of derivatives, interest rate swaps, anything that you see very more advanced markets. More or less, they always started with money markets. So my presentation will cover that. This is one area that we believe there's a lot of potential, both based on the regulatory aspect, the central bank utilizes money markets to regulate monetary policy, and then banks themselves leverage money markets to optimize their balance sheets, etc. So I'll dive into the details as we go in the presentation, but I just want to give this to you so you can frame it. So what I'll do is I'll talk a little bit about theoretical, what the background is on money markets, but also give some case studies on various countries and what's happening and the evolution of the money markets. You can hear me okay, right? To start off with, let's define things. What are exactly our money markets? Because this is not something we hear about every day. It's more like, one way I try to think of it is it's like the plumbing of the financial system. You don't always see it. It's like in your house, you don't see the plumbing necessarily, but you need it. It's very fundamental. So just to give you a definition, when we say money markets, it's really anything that matures in less than a year. So it can be an instrument like an interbank market, unsecured repos or secured repos, commercial papers. I don't know if you can see it on the right side, but certificates of deposit, T-bills, anything that matures in less than 1 year and is tradable. But also even common things like a demand deposit technically is a money market instrument, the money you put in your bank, because you can access it at any time. So anything that matures in less than 1 year. And then we define capital, and it's usually regulated by central banks around the world, a lot of these instruments. Capital market debt instruments, fixed income, treasury bills, which Evan will talk about later. Those are regulated more by the capital market authorities or security exchange commissions in various countries. And this is anything that matures in a year or longer. So higher risk, longer tenor. Just to state some of the obvious things, money markets are usually, a way to connect investors and issuers. The investors in these markets would be, banks, retail investors who have funds to park in low risk investments that they can access at any time very easily. And then borrowers tend to be banks, broker dealers, for example, market makers. They fund their market making activities using money market instruments. They borrow from the money markets. And this is the case across countries, developed, developing. And they're very, like I stated earlier, very essential to the development of capital markets. So this is one reason we're building a capital market from scratch here. So we've really paid a lot of attention to this side of the business. So if we can do this right, we really believe we can build the rest of the ecosystem better. So there's a lot on this slide. What we're trying to do here is really see, explain some of the things I've said earlier, like why do they matter exactly? So it touches many areas. So capital markets, secondary market for government securities market itself. So your treasury bills market is very heavily dependent on money market activity, as well as a central bank policy transmission, liquidity management for banks, as many of you in this room are aware. So what I'll do is I'll cover each one of these in a little more detail in the next few slides. And I didn't mention, setting the yield curve, of course, is very important. If you think about it on this chart, it doesn't show it exactly, but if you look at the right side, the first part below the 2 years is basically your money market yield curve. So anytime you're building a yield curve or a formal yield curve, any country in the world, you have to have a functioning money market. So your overnight rates, etc., they anchor the yield curve. That's your lowest cost of capital. So there's various things here. I think it serves as a market-based benchmark for other rates. It's a building block in asset pricing. So if you're familiar with the capital asset pricing model, it's how you value stocks. It usually has a risk-free rate, and that risk-free rate is built off of the interbank rate. Eventually, it's a treasury rate normally, or a treasury bond, but even that treasury bond rate is interlinked with your interbank rates. So it's a very key aspect of what you call a risk-free rate. And then a yield curve, it serves as a barometer of the wider economy. And what I've posted here is not really easily visible, but you'll get the slides after the presentation, so you can look at this in your own time. But it gives you some information as to what's going on in the economy. Generally, yield curves are upward sloping. So the longer farther out you go in the yield curve, the higher the interest rate. But also, it gives you information. So for example, and my Kenyan colleagues can correct me on this, but This chart shows the yield curve where it was 6 months ago, the dotted lines on the bottom. And you notice the blue line is a bit higher now. It could be higher inflation expectations, FX pressures, etc. But you get information out of it, number one, on the wider economy, and also the banking sector itself. Banks make money by lending long-term and borrowing short-term from depositors. So a lot of times you see correlation in terms of bank profitability, etc. If the yield curve steeps upward or the yield curve increases more, banks tend to be more profitable, they do more lending, and vice versa if the opposite happens. So on central bank policy transmission, I think I stated some of these points, but it touches many areas. Central banks conduct a lot of the monetary policy operations using repos. So they go into the markets, they inject money using repos when liquidity is needed, and when liquidity needs to be withdrawn, they do money market operations by taking money out of the system. So that's one aspect that the interbank market serves. Short-term lending and deposit rates in well-functioning markets are determined by the interbank market because it is the shortest, end. Prices, real economy, especially on the short end of the yield curve, and then reserve requirements, discount facilities. So the main point here is the interbank market touches many areas. It's very critical. We don't see it, like I said earlier, but it's very important to regulators, to the banking sector, and the wider economy in general. So one thing we'll try to do as much as possible, I think the way we've structured this workshop in general, just to step back, is we talk a little bit about the theory, but actually in the real world, how is it done? So what are open market operations, I think, be useful to, illustrate. In a simple case, what you're doing, the central bank is basically acting like a money manager of the country. So it's trying to match supply and demand of money supply. On a daily basis, it's monitoring. So this is what's happening in most countries around the world. And they use money market operations to inject money and take out money. So if you see on the left side, it might not be as easily visible, but when you're expanding money into the system, so let's say liquidity is short, so the central bank would step in and pump money into the economy. They'll use this transaction called a repurchase agreement. So it's a very short-term transaction where the central bank basically buys securities. So it buys T-bills, for example, from banks and give them money. Very short term, overnight, usually to 7 days. And then this is a temporary act. So this is sending a signal to the market, okay, I'm releasing money. I'm trying to increase the supply of money in the system. And then on the flip side, if there's a lot of inflation, for example, or the central bank wants to lessen inflation expectations, they would do contractionary monetary policy. So they would have an actual trading desk performing these operations every day, buying and selling repos. And we can discuss this at further length, but I think the key takeaway here is more or less, you are doing this to manage the money supply efficiently in a market-based manner and transparently. So that's the key thing. As we try to, evolve, we have Wenishat here from the central bank. So I think she can comment later during the panel discussions, but the goal is to eventually have the exchange, have the central bank work more efficiently to perform monetary policy operations like many other countries do. And she'll be able to comment on that better. And then also, the last thing I want to state is a vertical repo, just to give definitions. A vertical repo is just saying it's a repo between a central bank and a bank. And there's a horizontal repurchase agreement, which is between banks. So we'll cover that a little bit more in detail, but this is really your kind of starting point of money market operations. So even further to this, additional points. So we spoke a little bit about central bank policy transmission, yield curve. So for banks, for a lot of you in this room, why do these markets matter? I think this is probably more or less obvious, so I won't take too much time, but there are several angles of it that you can look at. One of them is that obviously liquidity positions. So your daily liquidity can be managed more efficiently when you're using the money markets. So if you have excess BUR sitting in the vault today, it doesn't have to sit and not earn interest. You can use the money markets to lend it very short term, lower risk, and get it back. And not only that, but it doesn't have to be unsecured. It can be secured using some T-bills. So a borrowing bank can basically lend out their securities for cash. So that's one aspect. So balance sheet management. Secondly, banks don't have to rely on standing facilities from the central bank. They can rely on each other. as well as other players, so pension fund, microfinance, etc., can be brought into the system, the money market system, so that you alleviate some of the seasonal issues that happen, that we see in the market. Also, obviously, not to state the obvious, but you have a proper platform to perform these trades. Having an exchange or any other kind of service provider that provides a platform, a money market platform, allows you to see a little bit more visibility into the market and can see where prices are, where interest rates are, etc. So you see a little more transparency, less transaction costs. The three key takeaways here is balance sheet management. It's more market-based and more transparent, and more using state-of-the-art technology to do this. Yeah, so for government debt markets, I don't think I'll spend too much time on this, but having better liquidity as a bank. So for example, what we see now is there's not a lot of participation in the treasury bill market, even though it's not long-term. But one thing we hear from banks is that I have to hold it to maturity. I don't have a secondary market. But if you have an interbank market, if you think about it, it gives you flexibility to cover your short-term funding needs, and you can participate more actively in the government debt market itself. That way, for short-term lending, borrowing, you can go to the interbank. But if you know that for 6 months, you'll have better seasonal factors that you can find, you can hold on to the security longer. So you'll be more incentivized to purchase the treasury bill in 6 months. If for your intermediate funding needs, you can go to the interbank market. So that's one area. Liquidity and depth improve in your short-term markets. And then I think, opportunity cost of storing government securities to maturity significantly reduces when you have a functioning interbank market. I think I spoke a little bit about this. So one product that I think as an exchange, we believe there's a lot of potential based on discussions with the MBE, as well as banks, is having secured interbank. So a lot of countries we see in Africa, they still rely on an unsecured interbank markets. But what you see in general in the evolution of interbank markets around the world is when it's become secured, the velocity, the trading increases significantly, and the risk reduces significantly as well. So as fresh starters, we want to really emphasize the use of the repo instrument. Technically, it's not a very complicated instrument. This has been around for over 100 years. And it's very short-term, low credit risk. All you're saying is, if I am a holder of securities, I'll give you my securities as collateral. It's a collateralized loan. So you lend your securities as a bank and you get cash. And then you will sell it at a very, you'd return the cash maybe a day or two later, very short term. And what we see in many markets is that the trade velocity of these instruments is very high because banks are constantly managing their balance sheets. Yeah, and legally, it's basically a sequential pair of sales. It's just a short-term interest-bearing loan against collateral, to summarize. And when I'm saying this, I'm really focusing on horizontal, so bank-to-bank transactions. I think, let's come back, a little bit, step back. Who regulates this market? I mean, I think I stated it earlier. It's primarily central banks. Central banks are overseers of the short-term money markets. They set the policies. And in terms of specifics, what are the approaches that are taken around the world? One thing we've seen is, as these markets have evolved and become much more sophisticated and deep, you have these things called global master repurchase agreements. So these are more or less standardized contracts saying, who's legally, how the markets legally operates, how defaults are settled, etc. So these are agreements that really cover a lot of cross-border transactions. So anything involving FX, there's an FX interbank market as well as a local currency. If you want to participate cross-border, etc. Generally, the best practice is to use this GMRA. But necessarily, one thing I want to emphasize is as a new starter in this area, you don't have to abide by GMRA principles on day one, especially if you're focusing on local currency issuances or local currency markets. There are national agreements. So Nigeria, for example, has a Nigerian master repurchase agreement that they use for local currency trades that is enforced by the central bank. And then you have national guidelines also issued by central banks and codes of conduct. And then secondly, I think bringing it a little more closer to us, exchanges also publish trading rules. So the SX will actually have a trading rule specifically to the repo markets that all dealing members have to abide by and go through. And then CCPs, etc. I'll talk a little bit about that later, but key takeaway here is that there's different prongs of regulation, but very well established, very highly standardized. Like I said earlier, a key thing to keep in mind is these are not very sophisticated products. So the regulatory framework is more or less something we can easily adopt that we see in other countries. So I think this is one interesting area is, how have interbank markets evolved over time? Like I said earlier, the US Federal Reserve, the central bank in America, started repos over 100 years ago, with basically none of the technology we have today, etc. Pricing transparency. And currently, I think I was checking, it's about $5 trillion was being traded on the repo market in 1 month. So that just shows you, I think the economy of the US is $13 trillion, roughly. So it's not insignificant. These are huge markets with a lot of players. It's not just banks, there's money market funds, pension funds are involved, because all you're doing is bringing short-term issuers and investors together in an organized market. So they've evolved a lot, being used pretty much by all central banks around the world, including a lot of the African central banks that we see, both East Africa, West Africa, etc. So that's kind of a macro view. In terms of trading systems, so one thing that's really helped the evolution is a lot of times your classical repo trade is usually bilateral. So it's me against facing one other bank. What's happened now is that you have a third party in the middle. So basically a clearinghouse. Kind of, if you're familiar with clearinghouses on the commodity side, it's a very similar concept here. Your clearinghouse, basically a buyer and a seller face the clearinghouse. They don't face each other directly. So it significantly reduces your counterparty risk. And then also combined with that, there's trading systems used by exchanges, etc., that have really helped evolve this market. So a lot of the world is moving in that direction. And then thirdly, like I said earlier, I think I stated this, a lot of loans, derivatives. So in the American market, where I used to work, I think about 80% of the loans at the bank I worked at were priced off of LIBOR. So they were variable loans. So if you go and buy a mortgage, so I had a mortgage, for example, if I decided on having a variable rate, it would basically fluctuate based on the LIBOR rate. So every month it would reset based on the LIBOR rate. So trillions of dollars were priced off of these assets. And this is the case in Europe, Japan, etc. So very important rate. Coming back a little closer to Africa, what we've seen lately is still maturing, I think, in terms of interbank, but a lot of progress in a short amount of time. I think a lot of payment systems, settlement systems, etc., have been modernized in many markets. So what you see here, the key highlight is you have some countries, almost 30% of GDP is the trading size. So, like we said, in America, it's really large, of course. But even in Africa, 30% in Uganda, Malawi, is the trade volume being conducted every year. And this is data, I think, as of 2021, so it's probably higher today. It's been 2 years. So what has helped is kind of, the financial markets, infrastructure upgrades, trading platforms. Some countries are slowly going to clearing, such as Nigeria. Although they are very low here, I think that number will increase quite a lot. Same thing with Ghana. They have, they've, I think, adopted GMRA now. The exchange is getting more involved in repo trades. So we expect these numbers to gradually increase as the market gets organized a little better. So a lot of progress, a lot of improvement in different parts of the world. So yeah, I think one thing we've studied as a team is what are the challenges? Why are African countries, not advanced as much in this space? Is what you see a lot is there's a lot of market segmentation. So large banks, for example, trade with other large banks. Even if the smaller bank credit is fine, etc., there's self-selection bias that happens. Also ownership bias. So foreign-owned banks tend to do more interbank trades as opposed to domestic banks, etc. Information asymmetry, the lack of the clearing structure without the third party in the middle, not as much secure trading, and then absence of guidelines, code of conduct. But also this presents a lot of opportunities because you can understand what the issues are. You can see how to provide solutions. So, developing collateralized markets, promoting repos a little more, increased adoption of these GMRA standards, and then obviously financial market infrastructure enhancements and credit guarantees. Credit guarantees, just to give quick, brief understanding and definition is basically you have firms, companies like FrontClear, for example, who guarantee repo trades. cross-border. So a Ghanaian bank can trade with a Nigerian bank, and the credit will be guaranteed by a firm like FrontClear or DFIs, etc. This will significantly boost trading. And also, having more participants outside of banks, fund managers, pensions, etc., would significantly boost activity. So these are a lot of opportunities we see, and we want to actually apply to our markets, at least from a starting point. As we discuss a little bit about the theory, the history, etc., what are we seeing in different countries? What are the most efficient markets that we see around the world? So we picked a couple of countries as a case study. The first one is Switzerland, which is pretty interesting because in Switzerland, basically the central bank actually conducts its monetary policy through the exchange repo system. So they were one of the first banks to automate repo trading about 25 years ago. And then, so two things happened. Number one, the central bank decided to do it directly through the exchange, number one. Number two, the exchange and the CSD, which is your central securities depository, where all securities are held, merged together. So you have an integrated exchange, CSD company, and then the central bank conducts its policy operations every day through there. And about 100 billion euros takes place on a daily basis. It's one of the most efficient systems probably in the world. So that's in Switzerland. It's significantly boosted activity, efficiency. It's become a role model actually for other countries around the world. More and more countries have adopted this approach in terms of automated trading systems for repos. And maybe let me stop real quick just to give definition. When I say automated trading systems, you're matching. It's not like you're picking up the phone, making sure you agree with 10 other people, or you're contacting 10 other banks, what the price is, etc. The system will show you basically the best prices and the best offers. And it's more efficient in terms of, as a treasurer, if you're sitting as a treasurer at a bank, quickly you can see transparently what the prices are, and it's lesser cost. I guess transaction costs are lower. I think coming a little closer, another case study we want to use, not really just for the repo market necessarily, but for fixed income in general, is called FMDQ. It's a relatively new exchange in Nigeria that some of you may be familiar with. But the way FMDQ is set up, basically, it has an exchange, it has a clearing group, or a clearing subsidiary that acts as a central clearing counterparty. So it acts as your middleman, in the tri-party repo. And then you have a CSD also. So it's an integrated exchange from top to bottom. So the exchange basically is where you execute the trade. You see the prices, you see the system, the yields on the interbank market. And then the operational standards, framework, etc., are defined by the exchange. And then your collateral types, is it government bonds, treasury bills, etc. It defines it clearly there. And then most importantly, I think, is pricing information. Every day prices are published on the exchange system. All members can see it. So where the interbank rates at, it's very transparent and reported on a regular basis. So that's the trading platform. And then the clearing, I think I don't have to say much, but it acts basically as your central counterparty. And then the collateral is valued every day by the clearing house to make sure that in case the collateral drops below a certain point, a margin is posted. And I'll explain that a little better later. And then your depository is your CSD. So what's interesting about this is that they basically have the whole chain. FMDQ was started by banks, actually, by the Central Bank of Nigeria, and banks are the main shareholders. So it's grown quite a lot in 10 years. You can look at it in your own time, but it's a very interesting model and something that we really like to emulate, I think, going forward. And the CSD from FMDQ is connected to the central bank CSD. So Nigeria has multiple CSDs. So the central bank CSD is fed all of this information on a daily basis whenever transactions happen. I think just this graphic, what I want to show here is that, as time has gone, repos, interbank, etc., used to be more OTC markets. And they still are to a certain extent, but exchanges have become much bigger players in this area as systems have advanced and efficiencies have come. So you can see all around the world, more or less, exchanges are playing a big role, especially in Latin America, in Europe, Ukraine, etc., Istanbul, like I said earlier, FMDQ, South Africa. All of these countries have exchanges that run repo markets, highly efficient. And we actually believe going forward, this will transition more and more to exchanges and automated trading systems. the lines have become much more blurrier between exchanges and OTC over time, because a lot of your OTC functionalities now can be performed on an exchange, anonymous trading, bilateral trading, etc. So I won't spend too much time on this, but really I think it's good, exactly how does a repo work? In general, what you're saying when you do a repo trade is that you are collateralizing a certain asset. So if you have a T-bill worth, let's say, 105 today, 105 birr, you are going out in the market and borrowing 100 birr. So that 5%, that haircut basically, is to ensure the lender. So the lender of the funds, it's basically what they're getting as interest. So that's the payment that they're receiving. And this depends on markets. And very developed markets is very low, actually, sometimes close to zero for overnights, etc. So, but in frontier markets, Nigeria, I think the data point I saw was about 5% to 10%. Obviously, depending on the volatility of the market, but in general, pretty low. And then this is agreed upon by the counterparties within the trading system or on the phone, negotiated ahead of time. And then every day, let's say you have a 7-day. So if you think about it this way, this is the left side is really at trade when you're initiating the trade. So your haircut is determined then, your market value, etc., is priced at T. And then after the trade is done, every day your collateral is revalued in the system. How much is my market value of my T-bill? Is it going up or down? And then it's marked to market. It's the concept of saying how much is the value of the collateral on a daily basis. So very transparent. Both counterparties can see it. And in the case of a CCP, if the CCP is managing or a central counterparty is managing, they would manage the margin on this. And I can explain this in detail if necessary. I just don't want to spend too much time on it. But yeah, basically what happens is if your collateral, let's say this 105, in 5 days is down to 95, you'd have a pre-agreed amount that you'd say, okay, I need to fund that collateral to get back up to 105 or so. So your lender or your borrower would have to fund that position back after a certain point. And that's usually agreed upon between the buyer and the seller at the time of transaction. It's what you call a margin call. And this is true with interest rates, derivatives, same thing with commodities. So conceptually, it's not that different. So if you're trading gas, commodities, soft commodities, etc., mark to market works more or less in this manner. So I think, as I'm trying to wrap up a little bit, coming back home, where are we at? We've discussed a lot about the global experience, the African experience. Where are we at in Ethiopia? One thing we've understood from our research and a lot of our engagement so far, there's a lot of appetite for an interbank market, but it's not organized. It's not formally organized. Banks do lend to each other, more in time deposit manner, very long term, if you think about it relatively. So there's no financial market infrastructure. A lot of it is done on the phone, high transaction costs. Shortest tenor that you can do interbank, as we're familiar with at least, is 3 months, which is quite long when you compare it to global experience and best practices. So a lot of liquidity is being locked up and not being optimized on a lot of bank balance sheets in our view, which can be very significantly improved with this market. Yeah, lack of short-term markets prevents these efficiencies. So looking at number 3, I think looking more optimistically, we do have the open market directive issued by MBE. It's just not been implemented technically, but it is there. The legal foundation is there for the monetary policy to be conducted using repos with banks. Electronic trading platform, CSD needed. So you need these key financial market infrastructures to operationalize this market. The good news is we are in the process of building that. I mean, that's part of this workshop, is to help you understand where we are. We will have that when the exchange launches. And then having code of conduct guidelines for these horizontal markets so that we have proper regulatory foundation for banks to trade with each other. So this is usually issued by central banks, but also by exchanges, as I said earlier. And we're working closely with the MBE and the team there to help actualize this over the next year. This is just to give you kind of dynamics. I think it's okay to discuss a little bit verbally, but what is the data showing us actually? In Ethiopia, we're very well aware, we know that right now there's a lot of liquidity challenges, structural changes that I think have happened in the last 6-7 months. But I think as analysts, we try to look at long-term trends instead of just the short-term what's been happening. So the chart on the right, what it shows you is basically what have reserves been? Excess reserves. So this is reserves in addition to what MBE requires. So on average, from 2011 to 2021, reserves were almost 60% higher than the excess reserves in Ethiopia on average. Obviously, they fluctuate a lot, but the long-term trend is telling you there's more reserves. Banks are holding on to more cash than they need to. And that's money basically that's sitting idle, not earning interest, etc. So if you think about the velocity, it multiplies quite a bit over time. So that's one thing. That's one inefficiency. It's an indicator of inefficiency. And this is actually seen in other markets in Africa too. This is not just here. Even in other African markets, we see a lot of excess reserve hoarding. So this can be significantly improved, I think, going forward. I think that's the main thing I want to say here. One main takeaway. So yeah, I might have summarized some of this, but I think just to kind of see where we are, what do we see in the next couple of years once ESX launches as it pertains just to this market on Interbank. So we'll bring the technology, the exchange will have the technology in place, that infrastructure we spoke about, the CSD, etc. number one. And then secondly, I think one key thing to bring about is being a latecomer, being a late starter, we don't have legacy problems, legacy system issues. We start fresh. So the best trading technology at a lower cost can be basically distributed to the environment. So the exchange system will take the burden of the cost, and it'll be basically providing this interbank market as a service. So banks, as they transact with each other, they basically pay as a service instead of having a subscription fee, etc. You can pay as a service and based on your daily needs. And obviously this will be discussed with banks, the fees, etc. will be very extensively discussed, clearly stated in the rules. And obviously you'd have your trade reporting, transparency, a lot of things we spoke about earlier, your mark to market, etc. from day one. So you wouldn't have as much information asymmetry and hopefully higher liquidity, etc. We don't expect it to be a perfect market, obviously, but with a lot of with time, with training, bringing in the stakeholders, organizing the market, I think we see a lot of potential in this space. I think in the long term, as we develop as an exchange, as a banking sector grows, we want to emulate the model that we see in other countries that brings the most efficiencies as an exchange. Having central clearing through the exchange itself. We believe, the size of the economy can support this, number one. And the banking sector itself is very large. I mean, I think as Ethiopians, we're always very cautious, etc. But if you look at the data, it's kind of interesting. We're almost equal to Kenya. I mean, we're reaching Kenya's in terms of assets, so loans, etc. In dollar terms, we're almost approaching Kenya, but growing faster. So I think about $45 billion worth in assets as of last year. Kenya is around 50 or so. So rapidly growing. We have the space, we have the population. And then you're going to have foreign banks coming in as well, who are going to be very active in this area. So I think that's one other thing to think about, I think, as bankers, as treasurers, is that they will be participating in this market. It will be an active market going forward. So the next steps, I think this is my last one. I think we've broken it out into kind of for banks, for the MBE, and then for the ESX. These are the key stakeholders I think we've identified. So preparation, what do you need? And my colleague Victor here will talk a little bit more about the fundamental day-to-day treasurers aspect of what they do. But you have to have your front office, your back office team, treasury team, training system, training, and then systems, onboarding, etc. One thing I want to really state here, and I've put it in the slide, but when we speak with bankers a lot, there's this, I think, feeling that you need a lot of staff to run these groups. To illustrate, I mean, my previous job in the US, I worked in a treasury group. There were 3 people managing a $12 billion portfolio on the treasury side. So you don't really need a lot of people. It's more of a capacity issue, more human capital. So it's very doable with proper capacity building and work. But I'll let Victor speak a little bit more about that. He has a much more practical experience in this area. And then from the MBE, like I said, we discussed quite a bit with Wayne Shatter and her team on how we can actualize this market, make it a proper market for the country. Having a trading desk in place is necessary. Like I said in one of the slides earlier, there's a proper financial markets desk in many countries, central markets that basically look at this market every day. That's their job. And then operating procedures help, guidelines for the central bank will need to be drafted, capacity building, peer central trading desks. So let's say Ghana, Nigeria, all these central banks have these functional trading desks that you can do a lot of peer-to-peer learning with. And then donors, etc., of course, can step in with technical assistance. And I think for us, I mean, we've said it a lot of times, we say this a lot when we engage with bankers directly, capacity building, sessions like this, but also coming, training banks at their location sometimes if necessary, treasury teams on the trading system, how to onboard, how to do it, how to use it, how does the actual market work, etc. Something we'll spend a lot of time with and work on with you going forward. And then we'll also kind of serve as a project manager for this market because we believe there's a lot of potential and we really want to help build a successful market. And then, formalizing treasurers associations, forming groups. We've seen a lot of successes in other countries in the region. The bond markets, etc., have taken off with the formation of associations, really. I think in Kenya, Uganda, and various countries, we've seen this. And we think it's a model we can emulate. I think that's it for my part. Thank you very much. And